Hi, I'm Tom Rutkowski. I'm president of Innovative Retirement Strategies. The purpose of this video is to go over what I call the double play model. This is an Excel spreadsheet that I use to present what I call the double play to prospective clients. And anybody who's interested in infinite banking or bank on yourself, private banking, used alongside real estate investing, this spreadsheet answers the main question that they have is, does this work? Does it make sense for me to purchase a life insurance policy, fund it, and then borrow against the policy's cash value to invest in real estate? So the model is just a simple A versus B comparison of one scenario versus the other. So at the end of all the sophisticated calculations, being a little overly dramatic there, it's just a spreadsheet. You're going to have a chart that simply graphs one against the other. But if you've followed my other videos and you understand how life insurance works and the overview that I did on the double play a couple weeks ago, you're starting off with less money because life insurance is not the perfect product. It's a very ideal product, but it's not the perfect product for this. It's life insurance. There's fees in it. We've tried to design all the fees out of the product, or out of the design for the illustration. But it's still life insurance. So you put money into the policy, you've got the fees taken out, you've got cash value, and then by the end of the year that cash value earns interest. But you can borrow against the policy's cash value from day one. You can do that either with a policy loan from the insurance company, or you can go to a third-party bank and get a line of credit against your policy's cash value. So if you do that, you're simply going to be giving the bank an assignment of collateral against your policy. That happens all the time. So what it really comes down to is building a spreadsheet model that simply compares A versus B. So I got interested in this when I got my insurance license many years ago. I told the origin story of this strategy in an earlier video, but essentially very early on when I got my license, I realized that one, I could design a policy that had a tremendous amount of cash value relative to the premium by what's called max funding, right up to the legal limit of what defines a life insurance contract. And then two, I learned that there are riders that you can put on the policy that eliminate the surrender charge. And then later I learned that there how you can design a whole life that accomplishes the same thing. And on whole life, you're dealing with paid-up additions, so those are liquid anyway. You don't even have to worry about an early cash value rider. So without further ado, let's dive into the model itself. So the model is just, again, it's a spreadsheet that's comparing A versus B. And let's start by looking at the inputs that go into the model. Up in the upper left corner of the spreadsheet here, and we're running this on a 40-year-old male client at preferred non-tobacco rates. And this is an illustration that I'd done, I think, just a week or two ago for a client. I just took the names out of it. But the input assumptions next to the row that I got highlighted here, the loan to cash value is the first input. And I have this for two reasons. One is, on day one of the policy, you have not earned any interest on it yet, while the illustration where I'm pulling the values from is showing the end of the year values. So I have to back out that first year's growth. Secondly, some lenders will not allow you to borrow 100% against the cash value, so you've got to account for that. So this is a user-adjusted parameter. If I send you this model, you can set that variable to whatever you want it to be. The next variable down is the interest rate. And again, you've got two different ways that you can borrow against the policy's cash value. The first is you can take a loan directly from the insurance company. This is nice because you don't have to fill out any application. There's no paperwork. You simply call up the insurance company, go through the voice prompts, and you end up speaking to the person who handles policy loans. You tell him how much you want. He tells you what your account balances are, verifies your account balances, and basically puts a check in the mail. Verifies that you understand what you're doing and everything. The alternative is getting it from a bank where you've got an application, you've got to make payments on the loan, but the beauty that you'll see here when we get into this is that the interest is tax deductible when you get a loan for business or investment purposes, and that's huge. You don't, trust me, you don't want to be doing this by taking a policy loan from the insurance company. You want to get a loan from a third-party bank. The other benefit of taking it from a bank too is that it really separates the loan from your policy's cash value. All too often people, even though they know they're taking a loan against the policy's cash value, they still tend to think that they're using their own money. And having a separate third-party loan makes it pretty clear that you don't have a loan. You're not using your own money. It is a loan that you have to make payments on. And if your investment goes belly up, you still got cash value. You still got cash value. I'm sorry. You still have the liability for that loan. So that loan will stay on the books secured by your cash value forever. So it helps the user use a little prudence in their investment selection. You're not just using your own money. So the next variable is the investment rate. You can put whatever you want in there. For the purposes here, I'm using a nice low conservative rate. I'm trying to show that you don't need to hit a home run in order for this to make it work. The assumption I'm making here is that let's just say it's a private loan at 9%, and you can change this to be whatever you want it to be. Since it's ordinary income, it would be taxed at ordinary income tax rates, and I've got 35% in here for that. Now, you can use the loan however you want. You could use it to buy rental properties, you could use it to buy fix and flips, tax liens, you name it, whatever you want. It's your money. But if you invest in income property, you've got depreciation that throws a little bit of a wrench in the way that I've calculated it here. But nonetheless, it's a cell that you can put whatever variable or whatever number in there that you want, so you can kind of fudge it to allow for what your effective tax rate would be, assuming depreciation. It might be 0. But if that's the case, you just put 0 in. The model still works. The next cell down is deduct interest. And while I don't recommend using a policy loan from the insurance company, I built the model so that you can flip the switch and show it either way. Here, by default, I just have it as you're deducting the interest. You're taking a third-party loan or loan from a third-party lender. The last 3 variables here are just inputs that are used to populate to the rest of the spreadsheet. The only thing that's truly pasted in that can't be changed by the user is the cash value. So everything in column E under end of year cash value is a column of numbers pasted in from another spreadsheet that where I ran the illustration. That's the Excel output of it. But everything else can be changed as far as what you do with the cash value. But if you want to make different assumptions regarding the policy, then you have to have a separate illustration run for yourself. So columns C, D, and E are the life insurance policy itself. So no matter what you do, as long as you're putting $20,000 a year into the policy and it's growing and achieving at least an annualized rate of return of 6.25%, which is what I've got illustrated here, that's what your policy looks like. And that happens whether or not you take a loan, because again, I like to make it clear, you're not borrowing your own money. You're getting a loan against or secured by the cash value of your policy. So what we're really interested in is what we're doing with the money. So let me just move this over a little bit. The end of year cash value, again, we're adjusting that number downward to fudge it for how much money you would have had at the beginning of the year. And the model's assuming that all of the money is working all of the time. So we're investing all that we can and earning that 9% rate of return. And then next year when we put another premium in, we're taking a loan against that and putting all of that money to work every single year. So all of the money is working all of the time. Now, is this real world? Probably not, because if you bought something with the first year's premium, obviously you may not have closed out that loan at the end of the year. So whatever you do with the second years, you may use all of it, you may not use all of it. And there may be idle times when your money's not working for yourself. But even if your money's not working for yourself, the beauty of this double play approach is that the cash value is still growing and earning what I consider a long-term rate of return. And that's a beautiful thing. All right, so we start with the end of the year value. The loan amount, assuming a 90% loan to value, is $16,553. In the first year, we're not reinvesting anything. This is the first year we're doing it, so there's no money to reinvest. So the total invested is $16,553. Now at 9%, the investment return is going to be about $1,490. So at the end of the year, assuming this was a 1-year loan, it was paid off at the end of the year, you've got $18,043 in the bank. On that, now that you paid off the loan, you had $786 of interest that you paid at 4.75%. You've got to pay back the loan principal, that's $16,553. And then you've got no return of principal, but that's because, again, this is the first year and you haven't put any of your own money into it yet. So at the end of the first year, you've got gross income of $704. And the tax rate gets applied to that. So we've got $246 of taxes to pay. And we've got net income of $457. That gets reinvested along with the cash value available from the previous year and the new premium coming in this year. So now we're taking a loan in the second year of $34,454. And the cycle repeats itself. So that gets invested at 9%, you pay your taxes and you reinvest the proceeds. And that continues on until, well, actually this runs for 45 years, no matter how old the client is. So at the end of the day, we've got the life insurance policy and we've got what we're doing on the side with it. So we're creating value over and above what's in the policy. So if the policy's cash value is earning 6% and we're earning income on the side here, all of that is in addition to the 6%. So let's see how it looks compared to just taking the $20,000 a year and investing in an asset directly at 9% interest rate. So let me just move this over. All right, here I've got it labeled as the doing nothing status quo. So this is you simply taking $20,000 a year and investing it directly in real estate at 9%. And again, the model is simple. Not back of the envelope calculation simple, but I'm not accounting for transaction costs, sales costs, things like that. I'm assuming all $20,000 is going to work at 9% interest. No commissions, anything like that. So again, we're not reinvesting anything because this is the first year, but we are assuming that all profits are being reinvested. So the total invested is $20,000 at 9%. That's an $1,800 return. Tax on that income at ordinary income tax rates is $630, leaving us with net income of $1,170. So that $1,170 gets reinvested along with the next $20,000. So we've got this year, the second year, we've got $41,170 that's going to be going to work, invested at 9% interest. So that continues along row after row, side by side, along with what we're showing on the life insurance side. So The bottom line is this chart, which simply shows the total accumulation over time of using the leveraged cash value to invest at 9% versus simply taking your cash and investing it at 9%. That's the blue line. So clearly, you can see that compounding interest is a beautiful thing. By the time you get 44 years out, 45 years out, you've accumulated almost twice the assets that you would have had you simply taken the money and invested it directly in real estate. Why is that possible? Again, because you're putting your money to work in two places at one time. You're starting off with less, mind you, right? That premium is being hit with fees, so you've got $18,000 going to work for you rather than 20, but it's growing at a higher interest rate because you're putting your money to work in two places at one time. You've got the combination of the side fund along with the original life insurance policy's cash value. So because the scale is so small, I mean, you can't even see it here, but the blue line is actually much higher than the orange line for a good chunk of time while the cash value is catching up from its deficit. So, even the first year, right? If $20,000 of premium turns into $18,000 of cash value, less than that one, because what was shown in the illustration included the first year's growth. So it's actually about 85% of that, right? So about $17,000. But that $17,000 is growing at a faster rate. So even at 10%, that's $1,700. That still doesn't get us back to the $20,000. So for a couple of years, you're actually going to be lagging where you would have been. But there's just, as this chart shows, there's just no denying the power of compounding interest. So this is just accumulation. What is, from my perspective as the president of Innovative Retirement Strategies, is what does this generate in retirement income? So assets are just a number on a piece of paper. You get a quarterly statement from your brokerage company every year showing you, or every quarter, showing you how much money you've got in your 401k or your brokerage account. But it's just a number on a piece of paper. Your house is the same way. You have a good idea of what your house is worth, but until you sell it, you don't have cash in your hand. And the same is true with your brokerage account. You've got a piece of paper with a number on it, but that piece of paper doesn't inherently generate income that you can spend when you retire. So income is what matters when you retire. So you've got to convert those assets to income. And this is where life insurance has a tremendous advantage. And I'll go into this in a future presentation or video and talk about why it is that life insurance can generate 2 to 3 times the income that the same amount of money in a brokerage account could. So let me just throw some sample numbers before I dive into what I've got here. If you had $1 million in a brokerage account, financial advisors typically use the 4% rule to determine how much income you can safely take from your savings each year without risking running out of money before you die. So if we assume that you have $1 million, for example, $40,000 is 4% of $1 million. So that's how much you could take out every year without putting in jeopardy the amount of your savings, without running out of money before you die. If you were to go out and take $1 million and buy an annuity, you're going to find that the withdrawal rate on that annuity is going to be around 4%. It's just kind of the way it is when you're taking money out of something. But the beauty of life insurance, as I've stressed a couple times in these videos, is the fact that you are leveraging or borrowing against the policy's cash value while you're taking income. So my rule of thumb is about 8%. And I've backtested this against numbers to see whether or not, if you had cash value on December 31st of 1999, right before the dot-com bust, could you have made it through those 3 years of down markets? And the answer is yes, at a 7 to 8% withdrawal rate, or loan rate, income rate. Gotta be very careful how I say that since I'm putting videos out there for posterity. So $1 million could generate income at an 8% ratio. So that's $80,000 a year relative to 40. And mind you, that 80,000 is coming to you tax-free. So if your $1 million were sitting in a traditional 401k and you have not paid your taxes on it yet, that $40,000 is going to get taxed at ordinary income tax rates when you retire. So if you're in a 25% tax bracket, to keep the math simple, that $40,000 is going to get taxed at 25%, and that means that your $40,000 turns into $30,000. $10,000 is 25% of 40. So $30,000 is the net after-tax income on $1 million of savings. And it's kind of depressing, isn't it? $1 million of cash value, on the other hand, generating 8% would give you $80,000 tax-free. So $30,000 versus $80,000 from the same amount of money. And that's why life insurance is so powerful, and why I've taken a little aside, gone down this rabbit hole on this video, because it all comes down to income. So income is what matters. So we've got two assets on the double play side. We've got the life insurance policy's cash value, which is capable of generating 8% income relative to the cash value at the age of retirement, versus where we would, the amount of assets that we've accumulated had we just taken $20,000 and invested it in whatever at 9% for all those years. So the numbers that you can see on the chart here are substantial, especially by the end of 45 years, but nobody's going to wait till age 84 to retire, I hope. But at age 65, the orange line, the double play, remember, you're taking income from the life insurance policy at 8%, assuming all the loans are paid off. And then I'm assuming that the side fund that we've created is spitting out income at the 4% ratio. And the sum of those two is $112,566 a year. Now, had we invested at 9% and applied the same 4% rule for income to the blue line, we find that number is right around $50,000. So it's a 2-to-1 difference in income for this person by the time they reach age 65. Remember, this is a 40-year-old client, so we're talking about only 25 years out in the future, and it's a difference of 2-to-1 in terms of income. Now, mind you, these are all projections based on user-defined inputs, but I've walked you through the model. You didn't get to see the calculations, but these are fairly simple calculations. It doesn't take much to build a spreadsheet that can do this. I do have an MBA in finance and investments. I kind of know what I'm doing here. So the bottom line here is this strategy works. It will clearly build more assets over the course of your lifetime, but more important than the assets is the amount of income that you can generate from your assets by the time you retire. So I hope this answers all of your questions. I hope this deals with the main concern that probably brought you here in the first place, which is, does that infinite banking thing really work? Does it make sense for me to invest or put cash into a life insurance policy to turn around and invest that in real estate versus simply taking that cash and investing directly in real estate? So that's it. If you're still interested in more information, I've got just a ton of resources available on my website. It's innovativeretirementstrategies.com. And I've got just a tremendous amount of content spread around a bunch of different pages, all dealing with retirement income and real estate investing in particular. And I've got a bunch of ebooks that are available for download. There's some premium content. I've got a few things that I consider to be value add and things that differentiate me from other life insurance agents that are out there that aren't necessarily trade secrets, but I don't want other people finding out what I do, right? So there's that, and then I've also got a Facebook group that I've set aside. Think of it as a users group for my clients as well as any prospective clients that I'm working with that are welcome to join that group. Post questions, ask questions of the group members. Nearly everybody there loves this concept. It is highly technical. Understands life insurance policy. Believe me, by the time you go through sitting down with me and understanding life insurance well enough for me to feel comfortable that you know what you're doing, that you're buying something that's a lot of money. It's a lifetime commitment. I want to make sure that you understand what you're doing. So everybody there understands the life insurance really well and can answer almost any question you can think of. I would put most of those people up against most of the agents that I know. So take that for what it's worth. So anyway, I appreciate everybody tuning in. Please like and subscribe to my channel. Like this video, subscribe to my channel. And I look forward to continuing this video series. Thanks.